Okay, I think we should be good. Hi, everybody. I am Amy. I am your TA. If you don't remember me. Today we're going to go over the fall 2019 exam 2. So if you have any questions, just unmute and ask me. Just interrupt. I'm not great at paying attention to the chat, so it's better if you just interrupt me. I'm sure if you have questions, other people do too, so feel free. We are going to start with part 2 because that's where most of the points are. And it's a lot easier to just circle multiple choice questions if you're running out of space at the end, running out of time rather at the end, rather than trying to like go quick on the multiple or on the part 2. You're liable to leave a lot of points on the table, and I really don't want to see that happen to you. So you should really consider doing part 2 first. This thing out of the way. Okay, so let's start. So first thing we're going to do is we're going to start with problem 1 and part 2. And this is a FIFO-LIFO weighted average question. You're going to have to do something like this. Make sure you know how to do this. I'm going to try to go through this slowly. So if you have questions, please ask them. It's really not complicated once you know what you're doing, but sometimes getting to that point, I know, can be a little bit tricky. So let's just go through this slowly together. And I use the BERT method. A lot of his students really like the way that he does it, and so we're just going to use it that way. If your teacher does it a different way, it all gets you to the same answer at the end. There's just different ways of organizing the information. So if you are not Dr. BERT's student and you haven't seen it done this way, the way that your teacher does it is just as good. If you understand that way, do it that way, that's fine. But the way that Dr. BERT does it starts like this. So the first one we're going to do is FIFO, first in, first out. And we are going to organize our information like this. We're going to say that we have sales, and we're going to have the on-hand stuff over here. So sales, at the end of the day, sales is what your cost of goods sold is, and what you have on hand is your inventory. So this is going to end up being your ending inventory. Okay, so beginning inventory, it tells us on October 1st, we have beginning inventory of 30 units that we paid $18 a piece for, and the total cost was $540. And then on October 8th, we purchased 20 more units at $19 a piece for $380. And then on October 15th, we purchased 40 more for 20. And that cost us $800. But now it's October 21st, and somebody actually wants to buy something, so we're selling 55 of these units. So if this is first in, first out, which units are we going to use first when trying to fill this order of 55? This is like the crux of the problem, right? So if we're doing first in, first out, that means that the stuff that was in there first is what we use first. So we are going to use all 30 of these at 18. So that was $540 worth of stuff. So we're just going to cross this out. Now we're still trying to sell 55. We've sold 30. We need to collect another 20 at 19. So that's 380. So this is going to get a little cross those out. So we still only have 50. We need 5 more, right? So we're going to sell 5. The only things we have left are the $20 ones. So 5 times 20 are 100. Now there were 40 of these, but we sold 5 of them. So we have 35 left at $20 a piece. And so that's going to be $700. And then on October 28th, we purchased 20 more units. Don't forget to do this because there's always going to be something at the end. And don't forget to add these last 20 units for 22 for 440. So at the end of the month, what you have on hand, what's left, because you bought all that stuff, right? But you sold some of it, so it's got to go somewhere. So what you have left is 55 units worth 1,140. And what you sold was 55 units worth $1,020. So this is your cost of goods sold. And this is your ending inventory. Are there any questions on FIFO? Good. All right, so let's come over here and do LIFO. LIFO is almost exactly the same as FIFO, except instead of taking from the top, we're going to take from the bottom. So we're going to set it up the same. We're going to have our sales on one side and our on hand, handwriting's bad, I'm sorry, on the other. And we're going to have the same inventory. Same things happened, right? On October 1st, we started with 30 units that were worth $18. That does not look like what it's supposed to, for 540. And then on October 8th, we purchased 20 more units for $19 a piece for 380. And then on October 15th, we purchased 40 more units at $20 a piece for 800. And now October 21st comes along and we are selling 55 units. Good for us. But where do those 55 units come from? If we're doing LIFO, instead of taking from the top, instead of taking the first stuff in, we're taking from the last stuff and we're taking the newest stuff. We're taking, in a rising price environment, the most expensive stuff. So to sell 55 units, we're going to take all of these $40 $20 units. So those are all sold. And then we have 40, we're trying to sell 55. So we're going to sell 15 more. So 15, but which ones are we selling? We're selling from the $19 units because those are the next ones, the next to last ones. So 15 times 19 is 285. That's a 5. Okay. So there were 20 of these $19 units, but we sold 15 of them. So there's not 20 of them anymore. There's 20 minus 15, which is 5 at 19, which is 95. And then let's not forget what happens on October 28th at the end of the month. We purchased another 20 units at $22 a piece for $440. So at the end of the month, what we have left is the 440 plus the 95. And don't forget what you had up here. We never touched those 18 units that we had in our beginning inventory, and we have to remember that they're still there. So if you add up those three numbers, you end up with an ending inventory of 1075. So it's still the 30 plus 5 plus 20. There's still 55 units. The number of units doesn't change. And over here, we still sold 55 units. Again, the number of units doesn't change, but instead of being worth 1,020, 800 plus 285 adds up to 1085. So your cost of goods sold is 1085 and your ending inventory is 1075. Does that make sense? Does anybody have any questions about that? We're all good? All right, so the last one we need to do is the weighted average. And weighted average is a little bit different. Before we had, I don't know what we were selling widgets, right? And so we had 30 of them that cost $18 and those were all sitting on a box. And then we bought 20 more and those were $19 and those were all sitting in a box. And then we had the 40 for $20, and those were all sitting in a box, and we were taking specific items. We knew how much each one cost, but now we don't care anymore. We're just throw them all together. We don't care which ones are 18, which ones are 19, which ones are 20. We're just going to charge the same price for all of them. So we set it up the same way. We have our sales, we have our on hand, and it looks the same to start. We have 30 units at 18, and they are worth 540. We have 20 units at 19, that's a 9, and they're worth 380. We have 40 units at 20, and they're worth 800. But we don't, like I said, we don't care which ones were 18, which ones are 19, which ones are 20. We threw them all together. We don't know. So we're just going to, we know that we have 30 plus 20 plus 40. We know that we have 90 units that all together cost us $1,720. That's what we know. So if we divide the 1,720 by 90, we get that each unit is worth $19.11. We're just calling them all $19.11, and in the end, we're just trusting that it's all going to work out. So when somebody wants to buy 55 units, we are going to charge them $19.11 for each one, and we're going to get $10.51.11. So now when we purchase more stuff, we have all those units left, but we sold 55 of them. So we're going to take out the 55 that we sold, and we're going to take out the $10.51.11 that we sold, so that we know that we only have 35 left worth $668.89. But those 35 units are still $19.11. That hasn't changed. And then when we add more to it, when we add the last 20 at 22 for the 440, we still have 55 units, but now they are $1108.89. And at this point, if you were to divide that $1108.89 by 55, you could figure out that each unit was now going to cost $20.16 if you were to make further sales. So if there was another sale, any more units that you sold would be for $20.16 instead of $19.11. That extra purchase in there changed the average price. So the $1108.89, this number here is your ending inventory. It doesn't like me to write off the page. And this $10.51.11 is your cost of goods sold. So that is FIFO LIFO weighted average. Are there any questions? Is there anything I can clear up for anybody? You got that? Okay. All right, so the next question is a bank rec. A bank rec isn't hard, but there is a lot of information to keep track of. So I like to set up the bank stuff over here. That's a B. And the book stuff over here. And they both start with the beginning balance. Right? Doesn't want to write today. Okay, sorry about that. All right, so the cash account balance, the cash account is in your book. So this 18, because they give us all this information, right? So this 18,273 that we see here is a book account. The bank statement balance, that's not a book account. The deposits in transit, that is also a bank statement account. The outstanding checks go on the bank statement, but The service charge on the bank statement not recorded in the books, that's something that the bank recorded that the book has not yet recorded. So if the book hasn't recorded it yet, that means we need to put it in the book. So that's going to be a book thing. There is a bank error. That's going to go, that means something the bank needs to fix. But then there's a check for repairs expense for $1,680 incorrectly recorded in the books at $960. So that's something else that we're going to have to do in the books. And then, as I was just saying, the bank statement, that's a bank thing. Deposits in transit is a bank thing. Outstanding checks is a bank thing. And a bank error is also a bank thing. So it helps if you go through the information and decide, okay, this is something that needs to go on the bank side. This is something that needs to go on the book side. So the beginning balance on the bank side is $16,315, and I like to cross things out as I use them. The cash balance account, that's a book thing, so that is $18,273.40. So that's a book thing. So deposits in transit and outstanding checks are always things that need to be adjusted on the bank side. There's very few things that need to be adjusted on the bank side. Deposit in transit, outstanding checks, and like a bank error are really the only things that go on the bank side, at least for right now. So if we have a deposit in transit, that means that that's a deposit that they haven't actually credited to our account yet. So that means that that's something that needs to be added. So deposits in transit of $2,800 need to be added to that balance because they haven't been added yet. And outstanding checks are checks that we've written, but people haven't cashed yet. So outstanding checks are something that would get subtracted from our account. And right now there are $1,850.8 that need to come out. Now it says service charge on bank statements not recorded in the books. So this is something that we decided was a book thing. So there's a service charge that the bank charges that we haven't recorded. So we have a service fee of $44 that needs to come out of our books. And then it says bank error. Another company's check charged on McGee Company's bank statement for $245.20. So somebody wrote a check on some other account, and for some reason it got taken out of our account. So that needs to get added back in, right? We shouldn't have paid for that. So if there was a bank error in our favor, that means we add it back into $45.20. Take care of that. And now it says check for repairs expense, $1,680, incorrectly recorded in the books as $960. All right, well, what does that mean? So that means that there was a check for $1,680, and it was supposed to be for $1,680 for repairs, but whoever put it in the books put it in wrong. They put it in as $960. So in order to figure out what we need to do, if we figure out the difference between $1,680 and $960, we get that the difference is $720. So we wrote it in our books as $960. It should have been $1,680. So we need to take an additional $720 out of our books because we didn't take enough out when we recorded that original journal entry. So if we have this error, so we need to take out an additional $720. And that takes care of all of our information. We don't have to deal with anything else. So if we add up both sides, we get that the $16,315 plus the $2,800 minus the $1,850.8 plus the $245.20 is $17,540.20. 509.40. And the 18,273.40 minus the 44 minus the 720 is also 509 rather, 40. So these things are the same. And that is a very good indicator that we did it right. It is possible for them to add up and you did something wrong, but if they come out the same, that's a very good sign. There are some other things that they could ask you about that they're not asking you about in this question, so make sure that you're familiar with those things as well. Some of those things might be like an NSF check are common things that we talk about. NSF checks are not sufficient funds checks. That means that somebody wrote us a check, we thought we had money, but it bounced, it was a bad check. And so we need to take that money out of our book balance. So that would be a deduction on the book side. If the bank also charged an NSF check fee, because a lot of times that happens when you write a bad check, a company like charges you a fee because their bank charges them a fee. So that would also be a deduction on the book side. And another thing that banks do, like we talked about before, deposits in transit, outstanding checks, bank errors, that's what you're going to see on the bank side. But there's other things that can happen on the book side. And another thing that a bank does is collects money for you. And so sometimes there are collections on the bank statement that you haven't recorded yet because you didn't know that they came in. So then those would be additions on the book side. So are there any questions? Just want you to be aware of all of the things that could go on in a bank rack. So the last thing that they're going to do is they're going to ask you to do the journal entries. So when you are doing the journal entries, you are adjusting cash on your books. You're not doing anything with the bank. The bank is responsible for making their own adjustments. You are just responsible for your books. And so if you are adjusting your books to cash, cash has got to come up somewhere. Every single time, cash will come up somewhere. If it's a deduction, you're going to credit cash. And if it's an addition, you're going to debit cash. So in this case, we have a service fee. Oops. We have a service fee expense for, how much was it? $44. And so we need to make sure that we credit cash for $44. And the other error, the other thing that we had to deduct out of our book was that error, right? So the error, it told us up at the top here that it was a check for repairs expense. So we need to add more repairs expense. So that was for $720. And because it's a deduction again, we are going to credit cash for $720. So those are the journal entries to adjust cash on the books. Are there any questions? Does that make sense? Okay. Oh, I was, we'll start fresh there. Okay, so this is the information that they give you. This last question is asking you about bad debt expense. So they're going to give you an aging of receivables. It's going to tell you how much is current, and then there's going to be certain things that are certain amounts of past due. And somewhere in here, they're going to tell you how much, what percent of all of these things they're expecting not to collect. So it says that 1% of current balances, 5% of balances 0 to 60 days, 15 for 61 to 180 days, and 30% for 180 days or more. So we're going to use all that information. Oops. Type so it's not so messy. All right, so current, it says it's 1%. So 1%. And so 1% of 592 is what, 5920. For 0 to 60 days, it told us that it was 5%. So 64,000 times 5% is 3,200. For 61 to 180 days, it told us 15%. And so 15% of 48,000 is 7,200. And for the last one, it told us 30%. 30% of 24,000 is 7,200. And if you add all those up, the 5,920 plus 3,200 plus 7,200 plus 7,200, you get that the total amount that they're not expecting to collect of their accounts receivable is 23,520. So if the total amount that they're not expecting to collect is 23,520, that means that's what the ending balance in the allowance for doubtful accounts should be. So question A says, what amount of bad debt expense will Jupiter report on its current income statement? So it wants to know the bad debt expense, and the information gives us what the final amount in the ADA should be. So the easiest way to figure this out is to just draw a T-chart. So we have the allowance for doubtful accounts, and it tells us in the question that there is a credit balance of $6,000. So that means that we have to put a credit balance of $6,000 here. And we know that the final amount is this 23,520. So the bad debt expense is this number right here. The bad debt expense is how we get from the beginning balance to the ending balance. So if you do the 23,520 minus 6,000, you get that this is 17,520. Right, because that's how T counts work. It's the 23,520 minus the 6,000 is 17,520, because stuff on this side is a positive, stuff on that side is a minus. This is a contra asset account. So 17,520 is your bad debt expense. The next question says, prepare the adjusting journal entry to record the bad debt expense. So this is a good journal entry to just memorize: bad debt expense, an allowance for doubtful accounts, 17,520. We had to credit our allowance for doubtful accounts by 17,520 to get it to 23,520, which means that we have to debit the bad debt expense. Expenses go up with a debit, so that all makes sense, right?
I have a question.
Yes.
Wait, so where did you get the 6,000 from again?
It was right in, right here. It was given to you.
Oh, never mind.
All right, so the last part says, if Jupiter used the percent of sales approach instead to estimate the bad debt expense, and the net credit sales for the year was $650,000, and by expectation 3% of net credit sales will be uncollectible, then what amount of bad debt expense will Jupiter report? So this, the way that we did it before, was the aging of receivables method. It was a balance sheet approach, and it gave you what the balance sheet account should be. The balance sheet account is the allowance for doubtful accounts, and it told you what the ending balance for the allowance will be. But this credit sales are something that go on an income statement, right? They're not a balance sheet thing. So an income statement approach isn't going to tell you about the allowance for doubtful accounts. It's going to tell you about the bad debt expense, right? The expense is also on the income statement. So it's going to just tell you straight up what the bad debt expense was, rather than over here on the balance sheet where we had to actually calculate the bad debt expense. We got what the ending ADA was. We had to calculate the bad debt expense. The income statement approach tells you about the bad debt expense directly. So in order to solve this one, we just take the 650,000 and multiply it by the 0.03, because 3% of our credit sales we're not going to collect. So the answer is 19,500, and that is your bad debt expense. So whereas before we found the 23,520, had to subtract, and we got the bad debt expense of 17,520. This time, they're not asking you to do the journal entry, but if they were, it would be bad debt expense of 19,500 against the allowance for doubtful accounts of 19,500. And if you had that allowance account with that 6,000 in it, you would just add this 19,500 to it. And then I didn't figure this out before, and I should have. The ending account would end up being 25,500. This is a different amount here. It's a different approach. So are there any questions about that? This question is only asking for this part. This stuff over here, this other stuff is stuff that is extra. You don't need to do that for this question. You just need this stuff here. But are there any questions? Okay. So that's part 2. If you can do all of those things, you should be set up for the exam. I'm going to go over the multiple choice questions for you now. I like to highlight the answers, and let's look at this 100%. All right. So if you have questions here, please stop me. All right, it says in specifying credit terms, 210, net 30, and 30 means that 1/2 of the invoice must be paid in 10 days with the net balance due in 30 days. Is that true or false? This statement is false. What this means, the 2/10 and 30, 210 net 30 means that if you pay within 10 days, so if you pay in 10 days, you get a 2% discount. Otherwise, it's due in 30 days. That's what that means. It doesn't mean anything about paying half the invoice in 10 days. It means if you pay in 10 days, if you pay the full amount in 10 days, you get a 2% discount. Otherwise, it's due in 30 days. All right, question 2. On which financial statements would you look to find the total cost of merchandise that remains and the total that has been sold? So the total that remains is the ending inventory. So where would you find ending inventory? You would find ending inventory on a balance sheet. And the total cost of the merchandise is the cost of goods sold. And the cost of goods sold is an expense that you find on the income statement. So what we're looking for here is the balance sheet and the income statement. The answer is B. Savannah Company purchases $120,000 of inventory during the period and sells $36,000 of it for $60,000. Beginning of the period inventory was 6,000. So what we need to do this one is that handy dandy equation. Does everybody remember that one? It's beginning inventory plus purchases minus cost of goods sold is equal to ending inventory. So it tells you that beginning inventory was 6,000. It tells you that purchases were 120,000. And it tells you that the cost of goods sold, we don't care about that 60,000. It sells $36,000 worth of inventory. That's our cost of goods sold. The 60,000 was how much revenue we made, but the 36,000 was how much that inventory cost us. So that's the one that we need, the 36,000. And so if we do the math there, we get 90,000. So that is the ending inventory at the end of the period. So the answer is letter C. Joshua records purchases at inventory price and uses the perpetual inventory system. On July 5th, Joshua returned 6,000 goods purchased on account to the seller. So it's a perpetual system, and there were purchases that were on account. So the perpetual is important and the on account is important. So one thing, this is just a stupid thing that I used to remember. If this doesn't help you, then forget about it, but it helps me. There's periodic, and that goes to purchases. And then there's perpetual, and that goes to inventory. The word purchases has a U in it, and the word perpetual has a U in it. And you have to keep those two U's apart. I like to think about vacuum cleaners. I hate to vacuum, and I also hate the way that this word is spelled. Why are there two U's in it? That's just ridiculous. Keep the U's away from each other. Periodic, you record purchases. Perpetual, you record inventory. So we know that we are using the perpetual system, so we don't want anything in it that has purchases. Purchases are gone. And now it's on account, but it's not accounts receivable, it's accounts payable, because we're returning goods that we purchased. So we had an accounts payable. So the answer here is A, because there's inventory, perpetual, we want inventory, and it's an accounts payable, not an accounts receivable. So if that helps you, great. If not, sorry. All right, number 5. For a firm that uses the perpetual inventory system, the sales return and allowances account is, the answer to this one is debited by the firm receiving goods from a customer. So we would debit the sales returns and allowances in order to take in that sales return and allowance. When merchandise was...
I have a quick question on that.
Yeah.
So, like, I had originally gotten that answer, but, like, I'm confused as to why, because, like, when we did it for the part 2s, you would normally have bad debt expense as a debit and then sales for doubtful accounts. So, like, I'm confused. Like, is this its own, like, the sales return allowance? Is this, like, a completely different thing?
Yeah, it's its own account. And it
Okay.
gets, yeah. It's not an allowance for doubtful accounts. It's a different thing.
Okay.
When merchandise was sold on account, when merchandise that was sold on account is returned using the perpetual inventory system, which accounts are affected in the books of the seller? So when merchandise is sold in a perpetual inventory system, remember our perpetual has a U in it, so it must go with inventory. So we're looking for something that does not have purchases, no purchases. So cash, accounts receivable. So that one this one here has purchases, so we don't want either of those. And it was sold on account. So on account means not cash. So the answer here is letter C, sales returns, accounts receivable, inventory, and cost of goods sold. Because the other ones have things in them that we don't like. Using a perpetual inventory system, the seller's journal entry to record the sale of merchandise on account includes, so if we are selling something on account and we are the seller, we record an accounts receivable and we record sales revenue. And then we also have to remember to update our inventory when we make a purchase. So we have the cost of goods sold that gets debited and inventory that gets credited. So the first one says credit to purchases, no purchases in the perpetual inventory system. This one says a debit to inventory. Well, no, we have to credit our inventory, right? So that's not right. Debit to accounts receivable, there it is. And then credit for cost of goods sold, no, that is not right either. So the answer to this one is C, debit to accounts receivable. In 2016, Bullseye Company earned a gross profit of $10,832 on net sales of $33,695. What is Bullseye's gross profit percentage? So the gross profit percentage is gross profit over sales. And it tells you what gross profit is, 10,832. It tells you what sales is, 33,695. And if you do the division, you get 0.321, which is 32.1%. That's just something you're going to have to memorize. Okay, so this one is fun. Let's do it in Reddit. So it says America Company reports the following year-end amounts. It gives us net sales, beginning inventory, net cost of purchases, and if we need to figure out ending inventory, cost of goods sold, and it gives us gross profit. And it says, what's the ending inventory and cost of goods sold? So what are the equations that we know that are going to help us figure this out? Well, we know that cost of goods sold, or ending inventory rather, is beginning inventory plus purchases minus cost of goods sold is ending inventory. Problem is we don't know cost of goods sold. So what do we know that's going to give us cost of goods sold? Well, they give us gross profit. So we also know that sales minus, we know that sales minus cost of goods sold is gross profit. And so if we know that, we also know that sales minus gross profit is cost of goods sold. So we know sales is 105. And we know that gross profit is 42,900. So that will give us cost of goods sold of 62,100. And now we can go back and plug into that beginning inventory equation, right? So beginning inventory shows us as 15,300. And then purchases are 67,500. 7. And then cost of goods sold we just figured out was 62,100. So we can come up with ending inventory of 20,700. This is ending inventory. This is cost of goods sold. That's a comma, and this is just a 100. So the answer to this one is right here. Are there any questions about how I did that? You just take the information that they give you and say, okay, what do I know? what else do I know? And manipulate until you figure it out. All right, number 20. When a company uses LIFO and prices are increasing, profits will be higher than if a company had used FIFO. True or false? Well, so LIFO starts with an L. L is for LIFO, and it's also for lower net income. It's lower taxes because our net income is lower. And it's also lower ending inventory. What's higher is our cost of goods sold. Cost of goods sold is higher, and that's what gives us the lower net income. So if a company uses LIFO and prices are increasing, profits aren't going to be higher, profits are going to be lower. We're going to have a lower net income. So this one is false. Under which method of inventory cost flows is the cost flow assumed to be in the reverse order in which the goods actually flow? So if you're a company and you have stuff sitting in inventory, you're not going to sell like the newest stuff first. You're going to sell the oldest stuff, right? If you're a grocery store and you've got milk, you're going to sell the stuff that's going to expire sooner to get it off of your shelves. You might actually report it differently, but that's not the way that the goods actually flow is first in, first out. So under which method of inventory cost flows is the cost flow assumed to be in the reverse order? Well, that is last in, first out. Okay, number 12, rubber company and foam company reported the following information in their financial statements prior to their mergers. To the closest hundredth, how much is the 2016 inventory turnover for rubber company? So we want rubber, so we're gonna just cross out foam. We don't care anything about foam. Now, inventory turnover is cost of goods sold divided by average inventory. So the cost of goods sold is here, it's given to us, but average inventory is actually, we have to actually average two numbers together. It's the ending inventory from 2015 and the ending inventory from 2016, because the ending inventory from 2015 is the same as the beginning inventory of 2016. So if we use the numbers that they give us, we get that 40,775 divided by, now we have to do the average thing, right? So 13,340 plus 16,880 divided by 2. So if you do that, you'll get 15,110. And so if you do the 40,775 divided by 15,110, you will get 2.699, which rounds up to 2.7. Are there any questions about how I did that? All right. The following data refer to Ward Company's ending inventory. How much ending inventory if the lower of cost or market rule is applied to individual items? So the lower of cost or market rule just means that when you price your inventory, it either has to be the lower of what you actually paid for it or what the market says that it's worth. So this is actually a very confidence boosting question, because the first thing you need to do is figure out which number is lower. So you've got all these items here. Which number is lower, the unit cost or the market cost? So of 128 and 152, which one's lower? Confidence boosting here, 128. How about 184 or 176? 176. 200 or 168? 168. 216 or 212, those are closer, but we still know that 212 is the smaller number. So now all we have to do is multiply these quantities by whichever number you chose. So 45 times 128 is 5,760. 60 times 176 is 10,560. 65 times 168 is 10,920. And 35 times 212 is 7,420. So if you add those four numbers up, you get 34,660, which is answer A. Are there any questions about that? It's pretty simple. Okay, so here we go. Requiring employees to take vacations is an example of a good internal accounting control feature. So you guys talked about internal controls a little bit. They're going to show up on your exam. So the answer to this one is true. It's good to make people take vacations, because if you force people to take vacations and they're doing something shady, then maybe somebody else will catch on to the fact that they're doing something shady. So that's a good thing. Which of the following would you add to the balance per general ledger to arrive at a reconciled cash balance in a bank reconciliation? So we want to know about something you would add. A bank service charge is something that you would subtract, right? They charged us money and we have to take that out of our account, not add it to it. Collection of a note by a bank, that's actually the right answer. That's something that you would add. The bank put that in your account, but you don't have that in your account yet. So you need to add that to your cash balance. An NSF check is a check that bounced. It's a not sufficient fund check. That's something that would get subtracted. And a deposit in transit is something that goes on the bank side, not the book side. So the answer to this one is letter B.
So for the note, is it because the bank knew about it first and that was something that we didn't know about?
Exactly. The bank collected it. It was like a direct deposit sort of thing. So the bank took it in, the bank has it, but we didn't realize that that person paid. So we need to add that in. The bank knew about it first. We didn't know about it till we got the bank statement. We're like, oh, Joe Schmo paid. Okay, great. So we have to record it at that point.
Okay.
Which of the following is a poor internal control accounting feature? So looking for bad things, right? Segregation of duties. Segregation of duties is a great thing. We like that. But combining authorization with custodianship, that can lead to some shady things. Rotation of personnel, that's a good thing. Internal auditing is a good thing. But if you let people authorize the money and also have custody of the money, it's very easy for them to steal the money. So we don't like that. 17, in establishing an effective internal control structure, management should establish a good control environment. I mean, that sounds good, right? They should also provide an effective accounting system. That's something that should definitely happen. Integrate control procedures into the control environment and accounting system. Definitely need to do that. So the answer to this one is D, all of the above. The net accounts receivable reported in the current asset section of a company's balance sheet represents all receivables expected to be collected within the next year. So the key here is net and all receivables expected to be collected, that expected to be collected. So the answer to this is true. The net receivables is what we expect to collect. The actual accounts receivable has stuff in it that we might not collect, and that's why the allowance for doubtful accounts subtracts it. The net receivables, we have the accounts receivable and we have the ADA, and when we subtract the two, that's when we get the net. Okay, the higher the accounts receivable turnover is, the faster receivables are being collected. So that means that That's true. Faster we're turning over our receivables, the faster we're being collected. That's just kind of the definition there. If the accounts receivable turnover was slower, that would mean that our receivables are hanging out longer and we're not collecting them as quickly as we would like to. Which of the following formulas computes the average collection period? So average collection period, so we're still thinking about our accounts receivable. So average collection period is the same as like the days of the days in accounts receivable. So this is 365 divided by the accounts receivable turnover. So the answer to this one is letter D. On which financial statement and at what amount are accounts receivable reported? So accounts receivable are an asset. Assets go on the balance sheet, and we report them at the net realizable value. The other answer that has balance sheet, we do like balance sheet, but that's at the amount owed by customers. Well, we do want all of the money that we're owed, but we are going to report it at the amount that we think we're actually going to realize, this net amount that we were talking about before. We are so close, I think. All right. A major shortcoming of the direct write-off method is that credit losses are, so the big problem with the direct write-off method is that there's no matching. It's not that they're not recognized, and it's not that they're not shown in the ledger, and it's not that they're sometimes collected in a future date. It's that there's the matching principle is violated. Accountants really like that matching principle, and when you violate it, they get very grumpy about it. So that's the big problem with the direct write-off method, is that it's not matched with sales. Under the allowance method of accounting for credit losses, the entry to write off a specific account. Okay, so when we write off an account, the journal entry that we do to write off an account is we're going to debit the allowance for doubtful accounts, and we're going to write off the accounts receivable with a credit. This is what we do. So the first answer, will increase total assets. So that's not true. When we write off an account, you would kind of think that it's going to decrease assets, but actually that's not going to happen either. So if you have an accounts receivable, an allowance for doubtful account, got some C accounts over here, right? If you have like 100, sorry, did not give myself enough space. So if you have like 100 in your accounts receivable, oh my goodness, start over. And you have 40 in your allowance for doubtful accounts. Well, 100 minus 40, your net AR is 60. So what happens if we write something down, right? So we have this AR and we have this ADA. And we had this 100 in there to begin with. And now we write off 20 of it. So if we do that, we have this 40 and we write off 20. So now we have 100 minus 20, so we end up with 80. We have 40 minus 20, so we end up with 20. Our net AR is still 60. 60, it's 60. Our assets don't change. So will increase total assets, that's not right. So debits bad debt expense and credits the allowance for uncollectible accounts. Nope, that's how we write up our allowance account. Bad debt expense, allowance for doubtful accounts, but that is not how we write something else. So that's not true. Write something off is the same as the entry to write off a specific account under the direct write-off method. So to write off something under the direct write-off method, that's when we use the bad debt expense against AR. So that's not true. So does not affect net income or total assets. Well, I already proved to you over here that it doesn't affect total assets. And allowance for doubtful accounts and accounts receivable, these are balance sheet accounts. Bad debt expense is an income statement account. So when we write off an account, it doesn't touch our income statement at all. It only affects things on the balance sheet, and it doesn't affect total assets either. So the answer to that one is D. So after writing off a customer's account, a company using the allowance method subsequently collected the account in full. It should. Okay, so if we write off an account, we have the allowance for doubtful accounts and then the AR, right? That's how we write off an account. So now it suddenly becomes collectible. So what do we do? So the first thing we need to do is put the account back on our books. It's gone. They can't pay it because, well, I mean, they can pay it, but we can't record it because it's not on our books anymore. So first thing we need to do is put it back on our books by just reversing that journal entry that we just did. And now that we have this allowance, this accounts receivable back on our books, now they can pay it. So now we record the cash and we write that AR right back off. So after writing off a customer's account, it should debit cash and credit accounts receivable. It should definitely do that. But let's just read the rest of the answers. Debit cash and credit miscellaneous income? No miscellaneous income. Debit accounts receivable? Whoops. Wrong. Debit accounts receivable and credit allowance for doubtful accounts? Oh, well, it should do that too. So the answer is both A and C. We have to do both of those journal entries. All right, last one. Zephyrus Company lends Vesta Company $200,000 on April 1st, 2016, accepting a 4-month 9% interest note. Zephyrus Company prepares its financial statements on April 30th. What adjusting entry should be made by Zephyrus Company before the financial statements can be prepared? So what happened was that we lent money on April 1st. So on April 1st, the journal entry that we would make is notes receivable, and we lent cash, so our cash goes down for $200,000. So this is already on the books, but now it's the end of the month and we need to do an adjusting entry. Well, there was interest involved here, right? There was 4-month 9% interest note. So for 1 month, what is the interest? Because that's what it's asking us to do, is accrue the interest. So for a $200,000 loan, at 9% times 1 month, we get $1,500. So the journal entry that we have to make on April 30th is to interest. We're not actually going to get the interest right now. They're not actually going to pay us. They're going to pay us in like 3 more months, but we have a receivable. We've earned that. So we have this interest revenue for $1,500. So we're not going to get the cash right now. They're going to pay us in a couple months. So C isn't right. And it's for $1,500, not for $6,000. So this one's not right. And the note receivable cash, this is the thing that we did already. We did that on April 1st. So that is not the right answer. The answer here is this interest receivable, interest revenue for $1,500. Are there any questions? Is everybody good? We all set? All right. Well, if there are no questions, good luck studying. If you have questions, you can send me an email. If you can do everything on that test, I think you should be in good shape for the exam on Monday or Tuesday, whenever you're taking it. So good luck studying, and I'll see you guys later, okay?